So the SBA, Small Business Administration, it's been around for decades. And really what the SBA does is it supports and backs up the loan that any bank is doing. And I think we're going to start to see the startup side of of SBA lending continue to grow as well as populations shift from other communities. People are moving, are going to need to build up their infrastructure of businesses, and assisted living is a big part of that.
Welcome to the Row Room Assisted Living Podcast with your hosts, Charlie Cameron and Alex Schlow. This is your go-to show for cutting-edge insights from industry leaders in residential assisted living.
Whether you're ready to launch your own assisted living business or looking to invest in this fast-growing, high-impact sector, we are here to equip you with the tools, strategies, and confidence you need to succeed. Get ready to ride the silver tsunami and change the future of senior care. Now on to today's show. Hello, everyone. Welcome back to today's episode of the Row Room Assisted Living Podcast. I'm your host, Dr. Alex Schlow, and today I am thrilled to have Zach Balmer on the podcast. Zach, do you mind giving us a brief introduction to you, and we'll tell folks what we're looking forward to on this episode?
Yeah. Thanks for having me. I'm super excited to be here. As Alex said, Zach Balmer with Lexicon Bank. Lexicon is a national SBA lender, and we're headquartered out of Las Vegas, Nevada. I sit in Boise, Idaho, but work on deals all across the country and have done a lot with the assisted living space. Wanted to chat about how SBA financing can really help with assisted living projects.
Absolutely. I'm looking forward to it. And Zach's being modest. He's got 20 plus years in banking. They are a national SBA lender in all 50 states, heavily focused on assisted living. Really excited to talk through the SBA loan process today because it can be complicated. Some folks think it's impossible. It's not. And there are tools out there and people out there to help you succeed from that perspective. So looking forward to breaking down with Zach exactly what lenders are looking for, how to set yourself up for success in the SBA process and go from there. But Zach, before we really get started on the nuts and bolts of SBA financing, how did you get started in banking and SBA lending?
Yeah, a pretty boring story is I graduated college from Boise State with my business management degree and was working in food service at the time and decided it was time to get a big kid job. At the time, I started as a teller at a bank, a national bank. Kind of just worked myself up through the ranks, became a branch manager over time. And then through those different roles, really got into the business lending side, which then ultimately brought on SBA background. And then I made the full switch several years back to go full into SBA, get out of the retail side of banking, and have been there ever since. So yeah, just graduated school and decided to get a job and was like, this looks like a cool job, and got into it. And here I am 20 plus years later, still at it. So
that is awesome. Very cool. Straightforward process, it sounds like. Grateful for that. Why has Lexicon and yourself, why have you guys leaned into assisted living over the past few years?
Yeah, so it really starts with Lexicon leaning into national SBA lending. Traditionally, they've been a regionally focused bank in Southern Nevada and really saw the benefit of really leaning into SBA lending. And part of me coming on board is I had done a lot of assisted living financing and had been involved with that over the last several years. And they really got excited about that being a potential vertical for us and looking at doing those. We see the need in that space as population is aging. And in a lot of these markets, there's just not a lot of capacity. And so there's going to be a need to expand that and grow that. And we see that we could play a vital role, which is what the SBA program has always been built to do, is to provide capital to businesses to create jobs, create businesses, and this fits perfectly well in that program.
Yeah, absolutely. I love that. And there's so much demand, and we all know about the silver tsunami and the supply-demand mismatch and so forth with assisted living, which makes this a really fantastic opportunity. What have you seen recently in terms of any specific areas that you tend to see more folks interested in getting SBA financing, or any trends that you've noticed over the last couple of years?
Yeah, really, we're seeing a lot of activity in the business acquisition space. That's really increased a lot, and it probably is going to increase more over the coming years, especially as the baby boomer generation retires and wants to be done with whatever they're doing. And oftentimes their kids or their family doesn't want to take over whatever business that they have. And so they're looking at selling their business. So we really see the acquisition side being heavy. We see that a lot, but we're seeing people start things. I think we're rolling into 2026. People are feeling a little bit more optimistic about where rates are going and stuff that might have been sitting on the sideline last year. People are jumping into the deep end this year and wanting to do projects. And I think we're going to start to see the startup side of of SBA lending continue to grow as well as populations shift from other communities. As people are leaving certain states and going to other states, those target states where people are moving are going to need to build up their infrastructure of businesses, and assisted living is a big part of that as there's the migration that's happening in the country right now.
Yeah, absolutely. That's a great question. Or a great answer. Sorry. Let's go ahead and jump into SBA Loans 101. What is an SBA loan? And then let's talk about the differences between an SBA 7A and an SBA 504 loan.
You bet. Yeah. So the SBA, Small Business Administration, it's been around for decades. And really what the SBA does is it supports and backs up the loan that any bank is doing. And so there's two types of SBA lenders. There's a preferred SBA lender, and then there's a non-preferred SBA lender. And a good vast majority of the SBA lenders out there are preferred. And what that simply means is that we have delegated authority from the SBA to not only approve our deal internally, but then once it's approved by the SBA, as long as we follow all of our guidelines and stuff like that. The non-preferred option, those banks and lenders have to physically send it into the SBA for approval, whereas we don't. So we're a preferred SBA lender, so we have that delegated authority. And so really just what that truly means is it just allows us to act independently of the SBA, and we follow the rules and guidelines, we get our authorization, and we have that guarantee behind our loan. So the loan itself is still serviced by us. It's still done by us at Lexicon. It's not something that's serviced through the SBA or anything like that. They just simply guarantee that loan. In the event that the loan defaults, the lender is made whole on 75% of the loss, and then the lender takes the other 25% loss. So it allows lenders like us to do riskier deals, such as a startup business or a ground up construction deal where you are projection reliant based on a business plan. Whereas on the traditional conventional side, those are harder deals to get done because there's no guarantee behind it. And there's typically collateral shortfalls and things like that. So that's where SBA fits. But then there's the two main programs that we work with the most, which is the SBA 7A program and the SBA 504 program. The SBA 7A, I would think of it as more of a catch-all program. It really can do everything. It can do working capital. It can do fixed assets. It can do ground up construction. It can do all of those things that you can think of under a normal product, or tenant improvements, things like that. The 504 is meant specifically for fixed assets. Anything that's a fixed tangible asset, like a building, equipment, anything like this, a physical tangible item, that can go under the 504 program, but then the other stuff cannot. So like working capital and things like that are not your fixed asset type of things don't qualify under the 504. So oftentimes if we're doing a 504 product on a ground up construction, let's say we're doing a 504 for the fixed asset side of it, and we're doing a companion 7A loan for working capital and the kind of intangible side of the financing. So they can work together in that case sometimes, but they are two very different programs in how they're approached. Your 7A loan is with one lender, us, and that's one loan. It's what we do. 504, you end up with two loans on the 504 product. One is with the lender that you're working with, and then we engage what's called a CDC lender in the area. And that CDC does the project on a second loan for 40% of the project or 35% of the project, depending on building and whatnot. But so you end up with those two loans on that product. And then if we have to do a third for working capital and stuff like that. So it's a little bit more complex on the 504 side, and we can certainly dive more into the nuances of that too.
Yeah, that's awesome. I think that's really helpful to have that distinguish. Yeah, it's really helpful to distinguish between the two. I'll say that 5 times fast. And I think that's beneficial and commonly confused. Are there any specific like maximums that you can have for each of these loans, a maximum amount that can be available?
Yeah. So the SBA has set certain caps. And the 7A program is a cap of $5 million loan amount, because then that caps our guarantee at $3,500,000, which is 75%. They do push it to $5.5 million on a 504 project. But the caveat to the 504 project is it's only the second loan that counts towards the SBA cap. So if you're talking 40% or 35% of the project cost, that's the only hit to the cap. Whereas on the 7A, the totality of the loan counts towards the cap. So sometimes if we're looking at a much larger project, that would send us over the 5 million cap on the 7A, it may make sense to look at a 504 because we have more cap space because only a certain portion of the loan is going to count towards that. So that's sometimes how we can manage that cap. Or if somebody's doing multiple projects over time, it's also another way to preserve cap for future projects. And so it just really depends on what the borrower's doing and what the motivations are and where things. And that's where our job as the lender comes in to really get a good understanding of what our borrower is looking to do long term. Because the 504 product itself is meant to be a long-term hold. 7A, not so much, because the 7A, and one of the key differences between the 504 and the 7A is you have a 3-year prepayment period on the 7A, whereas it's a 10-year on the 504. So oftentimes it's harder to get out of the 504. And so you really have to be dedicated that you're going to hold this for a while and not want to refinance out of it or sell the property. And so sometimes that can be the motivation of, hey, I'm bringing in some partners to the deal. I need to refinance them out in 5 years or 3 years or whatever that timeline is. 504 may not be the best product because of that longer hold and longer prepayment penalty. So it may make more sense to go the 7A option and then refinance into the 504 later. So it really, there's a lot of nuances there. And it just, like I said, it really pulls down to the conversation that we have with the borrower of just really understanding what their needs are and where they're going. And then that can kind of help us gear towards one product or the other.
Yeah, absolutely. I think having that strategy in place beforehand and then working with the bank to figure out what works best is super important. What are some common myths that you hear in the SBA space?
Yeah, obviously the big one that everybody talks about is what a pain in the butt SBA is. There, if you talk to 10 people, chances are 9.5 of them are going to say, "Oh, it's the worst thing ever. It takes forever." And there's certainly some truth to that. I think where people have bad SBA experiences sometimes is they're maybe dealing with a lender or a lender at that lender that doesn't necessarily know what they're doing with SBA. The SBA is changing all the time. A good example is they changed a rule in December recently around allowing 5% of ownership to not be a US citizen. They changed that in December. And then last week out of the blue, they came out and said now 100% has to be US citizen only. That's a rule change that happened inside of 2 months from one change to the next. And so what can happen with that is that if you're working with a lender that maybe isn't on top of the rule changes, or they're not on top of what's going on in the SBA space, it creates this kind of never ending of, oh, I need this, or now I need this, and now I need this, and now I need this. And it's, oh, I didn't know I needed to get that. And that kind of creates that experience where it's, oh my gosh, this is document overload. It is document overload. Business lending is totally different than what most people are used to. Most people are used to, I can go to the dealership and buy a car and walk out in a couple hours if you're lucky, and you got your car with you, or you go get pre-qualified for a mortgage and you can go buy a house this much money. The business side, we got to think of it as a mini audit in a way. Like we're going to look at everything that's going on with you on your personal financial. We're going to dig into the business plan. We're going to dig into the projections. If you're buying a business, we're going to dig into the financials of that business. And there's a lot of questions that will come with that. And so the process itself is by nature a longer process than people are used to. And so that's sometimes where that perception comes in of SBA is horrible. It takes a long time. And because we're used to quick decisions, I can apply for a credit card and get approved online in minutes. And it just does not work that way in the SBA space. We've got a government program that's overlaid on top of an already complex product, which is commercial lending. And we've got to hit every one of those marks on an SBA loan to be in the guidelines. And so sometimes it just creates more stuff that we got to get. And so I think that's the biggest misconception, is just making sure you fit with your lender. And that if you do, I think you'll have a much better SBA process and a much better SBA loan to where hopefully at the end of it, you're like, hey, yeah, it was a lot, but it wasn't as bad as I thought it was.
Yeah, that's a great answer, Zach. And I think too, that scrutiny is not necessarily a bad thing. I think I've jokingly said before that it's like a financial colonoscopy, but it's helpful because you want to see if there's anything wrong. And it's another set of like really experienced eyes looking at your plan, looking at your business plan and determining, hey, is this a good idea or not? And so it's not necessarily a bad thing to have that extra scrutiny, because there's a lot of folks like yourself who have tons of experience in the space. They have a lot of experience analyzing these opportunities. And if the bank's not going to lend on it, it's probably not going to be a viable project anyways. And so really important to have that extra set of eyes on it.
Yeah, what I'd say is, like, for us here at Lexicon, like, our approach is we don't want to set somebody up for failure, because the last thing that we want to do is put somebody in a loan product or a loan to where it's got a higher risk of default. Because at the end of the day, if a borrower defaults, they're personally guaranteeing these loans. They're potentially putting their assets on the line if they own a home or homes or other real estate properties as secondary collateral. And it's going to force us lenders to go take those assets. And then ultimately, they're going to have a loss to the federal government if there's a collateral shortfall still. And the government doesn't forget that. And they are going to keep coming and trying to get that collected. And it'll prohibit you from getting any sort of government financing until that loss is rectified.
Running a residential memory care home is not just a calling, it's a maze of licensure, paperwork, zoning regulations, and day to day challenges that can feel overwhelming. That's why so many successful operators partner with Legato Living Franchise. Legato Living does more than just help you open a home. They help you open it the right way so you can stay focused on what matters, providing exceptional care to those living with dementia. And once your doors are open, it can get lonely at the top. As a Legato Living franchisee, you are never on your own. Legato Living offers ongoing operational support from staff training and owner conferences to systems, cultures, and quality assurance because a home is only as good as its operator, and great operators deserve a great partner. If you're ready to open a residential memory care home that truly makes a difference, visit Legato Living and start with confidence today.
And so people can lose their whole financial life. And so that's something that we take very seriously here. We don't want to just do a loan for the sake of doing a loan because, hey, we did a loan. But we just want to make sure we're setting somebody up for success. And so that's where that deep dive comes into, is we've got to look at all of those facets and see, does this project make sense? And does this borrower set make sense to do that project?
Yeah, that makes a whole lot of sense. Let's talk about the approval process and how folks can look like a yes to the bank. Typically, I feel like lenders, from a high level overview, a 30,000-foot view, they're looking at borrower strength, they're looking at experience, business plan, projections, operations plan, property and deal structure. Anything else that you'd like to add, or what can folks be thinking about that they need to be able to justify to an SBA bank in order to first get through that approval process?
Yeah, so that's all of those are great points. Those are all very much things that we're going to look at. Really, what we look at from a high level overview is that, number one, we're going to look at the project. We're going to look at, okay, what is the project we're looking at? In this case, let's say it's an assisted living. Is this an acquisition or is this a startup? If it's an acquisition, we're going to evaluate the previous owner's finance or the current owner's financials. So that's tax returns, current interim P&L and balance sheet. Because the number one thing we're looking at is that existing operation kicking off enough cash flow to service the debt we are going to now ask this business operation to take on. So that's step number one on an acquisition. On a startup, it's totally different, right? There's no historical financials. So at that point, we're really evaluating the projections. We're evaluating the business plan. Does this make sense? Do the projections make sense? Are the assumptions, and what we mean by assumptions is the how and why you arrived at the projections you did, do those make sense? And if they don't, we're going to ask a lot of questions. Commonly in underwriting, that's probably the area we get the most questions, is around the projections. Is how did you get to this number? Where did that number come from? And the same will be true on an acquisition. You still have to put together a business plan. You still have to put together projections. And what you're wanting to do there is compare your projections back to the historical financials. Do they line up with and make sense given the historical financials? So it's really important as a borrower to understand the financials of the existing operation and then base your projections on that. So that's step number one. Step number two is then we look at our borrower set. So who are our guarantors? So what we're looking for there is, what experience are you bringing into owning an assisted living facility? If you've got direct experience, that's always going to be preferred. We're always going to want to see somebody that's been in the space before or have something adjacent to the space. It's not the end all be all. You can still do something that's different outside of your field that you've been in, as long as you've got some good transferable skill sets that make sense and map over to what you're doing. I always use the example of an engineer going to do a coffee shop or a restaurant. Does that make sense for an engineer to go do that if they've never worked in a restaurant? Because a restaurant is a totally different animal. Not saying an engineer couldn't do it, but we'd have to really understand that. And I've certainly done some deals in that scenario, but we have to really understand like what skill sets the borrower brings. And then really we're going to look at financially, we're going to look at the financials of the individual. So that's last year's tax returns or last 3 years of tax returns. We're going to have you put together a personal financial statement. And what we're looking for on that personal financial statement is, what does your liquidity look like? What does your net worth look like? Because if you're looking at doing a $4 million or $5 million project, we're going to need to see that be really strong. Obviously, it gets lesser and lesser as the loan amount goes down. But things we're looking for is that the SBA is going to require a down payment on any transaction that you're doing. Do you have the ability to do the down payment? And then if not, are you bringing investors into the mix? And then what is your post-funding liquidity? Post-funding liquidity, especially on a startup and an acquisition, are very critical to the success going forward. Because it's not a matter of if, it's a matter of when you're going to go through some sort of economic cycle or something's going to happen that was unforeseen or unexpected. And at that point, that's where that liquidity is important. So we can't just see, hey, I've got just enough to put the down payment down and then I don't have anything left over. That's going to create some anxiety for lenders when they're looking at that as, hey, there's no post-funding liquidity. And so a lot of times as we see bigger deals, sometimes in this space, there may be investors behind it. And so sometimes we have to look at what are the investors bringing to the table? Is this deal completely dependent on the investors? And if it is, like without the investor, this deal doesn't happen. Sometimes we have to look at bringing those investors in as guarantors on the deal to help strengthen it up. So we're looking at all of those things. And then at the end of the day, what collateral is there? Because a lot of times, especially if it's a startup, we're layering things on like working capital and stuff like that, which oftentimes is not offset by the building or something like that, the real estate. So we got to look at the individual and see if they're bringing any collateral. We don't get hung up necessarily on collateral shortfall. There are lenders out there that they want to be either fully secured or if it's too high of an exposure, they may have an issue with that. But we don't get hung up on that. We follow the SBA rule on that. But if all of those things check out and at the end of the day, it makes sense for this person to do this deal, we're going to get there. But if any one of those things are weak, we've got to take a look at, okay, are we strong enough everywhere else to offset that weakness? Or if there's too much weakness, then is there a guarantor that can come in? Or is there other things we can do to mitigate it? But if we can't, then it's hard to get those deals done.
That makes a lot of sense. Are you seeing specific documents that are often missing when folks are submitting their packet to the SBA?
Yeah, biggest things that you're going to want to know and bring to the table is we're always going to ask for a resume. So if you don't have a resume, now would be a good time to get one put together if this is a project you're looking to do, because we need to understand what you've been doing. That's a big piece of understanding who our borrower is and if they have a skill set to be able to do a project like this. The other thing is understand what your financial picture looks like. So the personal financial statement is going to ask for all of your debts, your balances in your bank accounts, retirement accounts, investment accounts, what's your house worth if you own a home, what's your current mortgage balance on those. It's a very detailed statement that you're going to need that kind of information at the ready to be able to put together. Really understanding where you're at on that. Those are very common things that are missed or on the PFS or the personal financial statement, they're typically not filled out correctly. People are missing debts on it or they're missing accounts that they have. And then the other thing is that we have to verify that your liquidity. So having your last couple of months bank statements or retirement account statements, investment account statements, have those ready when you're ready to do an application, because we're going to ask for those. Tax returns, a lot of times people don't save their tax returns, and so they've got to reach out to their CPA. So again, if you don't have the last 3 years of tax returns, getting those from your CPA or whoever, so you have those kind of saved and ready to go. We're also in that period of time right now where 2025 is over and people are starting to file 25 tax returns. So sometimes certain scenarios may get to a point where lenders, hey, have you filed tax returns? Have you filed this? So we need to look at those as well.
That's awesome. That's really helpful to set folks up for success from the beginning and start gathering those documents ahead of time, because it does take work. And just putting together a personal financial statement can take some time. Something that I've started doing in the last year is every quarter going in and updating that personal financial statement, because a lot of times folks will do it one time and then years will go by and they forget about it, and then they need one done and they forget how long it takes to actually do that.
Yeah, and that's key, is those documents are only good for 90 days. And so there's a lot of times where we'll get that up front from a borrower, but the project just takes a long time. And sometimes we have to update that a couple of times along the way, just because once it gets outside of 90 days, it's stale dated and you got to get an updated one. So that's great advice to continually update that and have that ready.
Yeah, absolutely. Thank you for that. What does a strong assisted living business plan looks like? I'm coming to you, I'm a first-time borrower. What are some key things that you're looking for in a business plan that's going to be beneficial?
Yeah. So the biggest things on a business plan is that we're going to look at really getting good firm details of the business, right? What does this look like? Who are our players? What are they all doing? Who's the competition? What are the market conditions? What are price points? What sets you apart from the competition? Just really whatever makes you unique. And, what I always say on a business plan, you certainly don't need to write a novel, but it can't be a page and a half either. Like it really needs to be a detailed plan, because at the end of the day, when this goes to credit and credit's looking at that, oftentimes on the front side as the BDO, we're talking to the borrower over a several month period of time or several week period of time. So we've got a good handle on what it is that they're doing. The underwriter hasn't had that benefit. So to them, the business plan is really everything, and it tells them exactly what's happening, and there's no such thing as too much detail. And one of the things that we provide is the SBA is really good. They have a couple of templates out there that we have at the ready to send to borrowers to help. It's a good guide of, here's an example of a business plan that the SBA says is a good business plan. But then there's also resources out there too. A lot of times there's an organization called SCORE that's out there that's funded by the SBA, and some markets have those. Those organizations are great at helping with business plans and projections and things like that. But then there's also companies for hire that do that as well. So it's really the business plan, the projections are really the meat of the deal, in my opinion. And sometimes that's often the most rushed through thing that people do, because they see it as, I got to get this task done and I'm just going to fly through and get it off my check the box, right? That's for me where I would spend the most time. Make sure you've got a good detailed plan. Make sure you have good detailed projections that really show the growth rates. They show any seasonality or trends, but they've got good detailed explanations on how you arrived at the numbers that you did. And I think if borrowers spend more time there and get that more correct up front and more detailed up front, it really helps the process be smoother and better on the back end, because there's going to be less questions that are going to come later.
Yeah, that makes a lot of sense. And that's really helpful. And again, those are things you can start working on now. You can really start gathering a business plan together now and working on those projections as you're going through this process, so that you don't get to the point where you're ready to start getting documents together for lending and go, oh no, I have all this to do. Because it can seem like a lot. It can be overwhelming. I think back to that old saying, you know how to eat an elephant, one bite at a time. Yeah, exactly right.
That a lot.
Yeah.
Deals are hairy deals and they take time. And so, you have to just take it methodically, one step at a time. And like I said, as much as you can plan ahead now and have a lot of that stuff knocked down, it'll really just help the process go smoother. And like I said, we've got tools that we're happy to share with people, the business plan templates. We've got a projections template that we are happy to share with folks as well, that can really set them up for success on what that looks like. We don't expect somebody to go reinvent the wheel there, but certainly if somebody's savvy enough and creates their own templates and their own projections, their own business plan, we're totally going to use those. They don't have to use ours or the SBA's version or anything like that. It's just a lot of times people that are doing this have never done it before. And so it's nice to have those templates that can kind of help be a guide.
Yeah, all those extra resources are definitely valuable for sure. Let's talk about, Zach, any differences about residential assisted living or assisted living loans in terms of like licensing or compliance or occupancy assumptions or ramp up timelines or staffing plans and operational readiness, anything like that you would tell folks to think about and make sure they have a good understanding on how to address those things?
Absolutely. What I would say is every community is different. Every city, municipality is different of what they're going to require on these things. So that is always going to be a question we're going to ask. It's impossible for us to know every city in all 50 states of what their requirements are. So we're expecting you to have done your homework on these are the licensing. We'll of course double check that on the backside, but really understanding what licenses you're going to need to operate those, if there's any sort of education pieces that have to be done or anything like that need to go into that, because obviously that's going to be critical to operate. So think of, for us to fund a loan, everything's got to be ready to go. One of the things that's also, if this is ground up construction, you've got to have your permit in hand before we can fund. The reason for that is if we fund loan and the permit never comes, it's an ineligible SBA loan. So there's things like that, like a permit has to be there for construction. We would expect any licenses that the city or municipality is going to require, you've got those before you open, because otherwise you can't operate. And then all of a sudden you've got a potentially $3, $4, $5 million loan that you can't service because you're not open and operating. And then really understanding too, what is that ramp up period? If this is a startup, right? You're opening the doors with 0 residents. So what does that look like in terms of a ramp up period? And that's where really probably understanding your market and understanding what the competition looks like how many beds are in the market, how many beds are full, does your competition have wait lists? Because that's going to help you gauge potentially how fast you could fill your facility. If every spot in town has a wait list, chances are you're going to open the doors and have quite a few residents right out of the gate because there's wait lists everywhere else. If there's capacity in the market, then that ramp up period might be a little bit longer because there is open capacity at your competition too. So really understanding the market conditions and what is happening in each of the facilities in that market and where you're looking to be is going to be critical in understanding what that ramp up period is going to look like. Because again, that's critical to us from a post-funding liquidity standpoint, because if that ramp up period is longer, then either A, we're going to need to include more working capital into the deal. We're going to have to rely a lot more heavily on your post-funding liquidity. So that's a really critical element of everything that we do to evaluate these. But then also just understanding what kind of model you're going to be in. Are you going to offer skilled nursing? Are you going to offer those types of things? Because those are going to have different requirements than, say, if you're doing something where you're bringing doctors in as opposed to having something on staff. So it's much different depending on the model. And obviously those requirements are going to change from city to city and model to model.
Yeah, absolutely. Yeah, that goes back to that business plan being really important. And I think for folks who are listening too, as soon as you start thinking about an assisted living home and getting started in residential assisted living, you got to start marketing. Marketing starts on day one. And so the more of these rooms that you can get pre-leased, especially if you're doing new development or you're renovating to an assisted living home and it's vacant, the more rooms you can get pre-leased in your home is going to be huge to shorten that ramp up period as well. Because as soon as you have one resident there, you're going to have to start paying for 24/7 care, and that's going to be your most expensive expense. And so making sure that you are accommodating for that's going to be really important. We see a lot of deals and opportunities where folks have not taken into account how long that's going to take, and they don't have the reserves or they don't have a plan to have that post liquidity, as you mentioned, post funding liquidity. And so that's really important to keep in mind. Awesome. Zach, what would you say is one instant red flag that a borrower would have that you're like, hey, this is just not going to work out?
Yeah. So one of the misconceptions that sometimes exists out there is that if you had a bankruptcy from a long time ago, we're not going to find out about it. We will. So every lender pulls background reports, and so even if you had one from 30 years ago, it is going to pull up. It's not impossible to get a deal done if you've had a previous bankruptcy. Life happens, things happen, medical events happen, a variety of different reasons why people do that. It is, however, one of those predictors of, okay, if somebody's done it before, they're more familiar with the process, it's easier to do it again. And so when you're looking at a larger loan and you're looking at potentially a startup loan, which is one of the more risky types of deals a lender does, that bankruptcy is going to weigh into that a little bit of, okay, we're going to want to know what was the story, what happened, how long ago was it, and if there's any sort of current recent credit history issues, like you've got late payments or you've maxed out credit cards, things like that. Those are going to be hard sells, and those are going to be hard to get done because we're going to see a profile of somebody who has a previous bankruptcy, they've got a high debt load now, or they've got some recent late payments. Those things in hand are going to be like, are we on the verge of something like that happening again? So a lot of times that'll be a big red flag of, hey, we may not be able to do this deal. A bankruptcy by itself isn't a disqualifying event. Unless it's more recent, like within the last 5 years or even within 10 years. So you want to see some history there. But if you've got good, clean credit today, this thing was a long time ago, or there's a good story there of what happened, like lenders can get around that. It works through that. But that's one red flag that I would say. No cash. If you're coming and asking for a $3, $4, $5 million deal, it's going to be hard to do those. If you get a personal financial statement that says you've got 100,000 or less to your name, that's hard because you're looking at a larger project that maybe you're going to be very dependent on an investor. So that's where we're going to have that investor probably mitigate that risk. We're always going to have to be looking at those different things. So those are a couple that come to mind right off the bat is just what are the cash? What is the stuff that has happened in your past?
Sounds good. That is awesome. Zach, any key takeaways you want to leave the audience with before we wrap things up?
Yeah, one of the things that I would say is just really at the end of the day, like this is a journey. I would say that this doesn't happen overnight. It's something that's going to take some time, especially if you're doing a construction project. You got to take time to find the land that's going to make sense. You got to vet a contractor or multiple contractors. You got to get architectural plans done. You got to get, everything set to where you can go even ask for a permit at that point. And then depending on the municipality, permit process can take a while. So it's not uncommon for a startup construction deal, it could take months to get done over time as you start on the journey. So just know that when you start talking or we sit down and have a conversation, it's the first of many and it's going to take a while. I've got a couple of assisted living deals that I'm working that are actually in underwriting right now. In both those cases, I started talking to these guys a year ago, probably. And that's their journey. And now an acquisition is certainly going to be faster than that. And you've got an existing operation, but even that's going to take some time. So just know that going into the process, it's going to take some time.
Yeah, absolutely. It sounds like too, just like with every great journey, you got to make sure you're packed and prepared appropriately and you're setting yourself up for success from the beginning. And so it sounds like getting started, talking with a bank who has experience, who's willing to help walk you through the process like Lexicon and get started is really important, and that you really can't start that process too early. So I think yeah.
And that's the other piece too, is don't hesitate to start asking questions early. The more you can ask those questions, and there's no such thing as a dumb question in the SBA space, because again, not everybody's gone through that. The majority of people have never gone through this process. So that's where we're here to help guide you through the process. We want to get you the right information so that you don't make a mistake along the way that could jeopardize you.
Absolutely. I love that. Zach, how can folks reach out to you if they want to know more, if they want to connect with you?
No, it's great. Yeah. So email's great. So my email address is zbalmer, ZBALMER at lexiconbank.com. And then my cell phone number is always the best way on the phone is 208-869-9033. So either of those are great. Text works great too. So whatever's easiest for you, we're happy to do that.
Awesome. Sounds good. Well, we'll be sure to include those links in the show notes as well. Zach, thank you so much for your time today. I think this was really helpful to combat some myths of SBA financing, kind of work through how you can set yourself up for success from the beginning. And bottom line, it's never too early to start that discussion and get going. So thank you so much for your time today.
You're very welcome. Appreciate the opportunity to be here.
Absolutely. Thank you so much. Take care.
You too.
All right. Bye.
Bye.
Thank you for tuning in to the Rail Room Assisted Living Podcast. We hope you found today's episode insightful. If you enjoyed it, make sure to leave us a raving 5-star review. And a quick review helps more listeners find the show and more seniors get the exceptional care they deserve.
And don't forget to subscribe so you never miss an episode. And just so you know, we have prepared some free resources for you to help you succeed in residential assisted living in addition to this podcast. Head over to theralroom.com, that is the RAL room.com, to download our free 10-step guide to launch your first or next residential assisted living home, or our 10 reasons to passively invest in residential assisted living ebooks.
And if you're ready to take the next step and make real moves in the RAL industry, join us in the Rail Room Mastermind. It is an exclusive community where we deep dive into everything you need to launch and grow your own residential assisted living business. You'll get access to recorded courses, live calls with industry experts, a RAL calculator, resources and tools, like-minded entrepreneurs, funding opportunities, and an expert networking community to help you along your journey.
Be sure to join us next time on the Rail Room Podcast as we continue to explore the world of residential assisted living with more great guests. See you then.